if we are in a deflationary scenario, what would that mean, not just for the US economy, but even globally? What would some of the ramifications be?
Yeah, great question. This is everything I'm describing. We've been focusing on the US, but the US is the world's largest economy, and the dollar is the world's largest payment currency and reserve currency, et cetera. So it's a good place to start. But we're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession or Japan or the US, but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening, and that's what we had in 2008. Pardon me. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's having some tough times, and a lot of this is dollar related. All the other countries, I mentioned Switzerland. India, China, Japan have all seen their U.S. dollar reserves go down, and everyone's like, "Oh, they hate the dollar. They're dumping the dollar." No, it's the opposite. They don't have enough dollars, so they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the US dollar. And, about 60% of global reserves, 80% of global payments, it's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once. Disinflation, borderline deflation will prevail. And by really just in a few months, January, February, March 2023, if not sooner, we're going to be in a very severe recession. And people are going to be surprised at how quickly inflation comes down, and they won't be positioned for it in terms of their portfolios. I mean, for example, a 10-year treasury note would be a very good performing asset in this world because yield to maturity on 10-year treasury notes has been recently 4%, but now it's around 3.5%. That could come down to 2.5% in a heartbeat, even lower, and that would produce huge capital gains. So it's a big deal for investors and asset allocation and portfolio management, and a lot of people don't see the disinflation coming. Inflation's here. We all see it. Price of gasoline, eggs, milk, butter, groceries at the store, rents, electricity, home heating, fuel, you name it. Across the board, inflation's affecting everything. And it started really in mid 2021. So here we are, almost 2023. So it's been going on for well over a year. For the first 6 or 7 months, Jay Powell and for that matter, Janet Yellen were like, yeah, we see it, but it's transitory. We know that story. Finally, November 2021, Jay Powell threw in the towel, said, okay, time to retire the word transitory. Now let's get to work. And they started raising interest rates in March 2022. And we're now up to Fed funds rate of 4%. They're going to raise them again in December 14th by another 50 basis points. We kind of, still a little bit away from that, but we know it's coming. The Fed, this is the no drama Fed. They tell you what they're doing in advance. So I always say you don't need a crystal ball to figure out the Fed. You just need to listen to what they're saying and believe them. So they're going to do 50 basis points in December. That'll get the policy rate of the Fed funds target rate to 4.5%. But that's from zero. March 1st, it was zero. So to go from 0 to 4.5 in less than 9 months, about 8.5 months, that's amazing. We haven't seen anything like that since Paul Volcker in the early 80s. Now I know rates are not 13, 14%, but to go from 0 to 4.5, I can say in 8 months is a shock. Now, why is the Fed doing this? Well, they say they want to kill inflation. Okay. But there are two sources of inflation. Inflation can come from the supply side, what's called cost push inflation. Costs go up and they get pushed into retail prices and consumer prices, and that is what's happening. That's because of the supply chain breakdown, energy prices, shortages of goods, et cetera. So that's cost push inflation from the supply side. There's another kind of inflation that comes from the demand side. And this is much more psychological. It's when consumers say, they just have it in their heads and maybe from objective data that prices are going up. And so they change their behavior. They say, I was thinking of getting a new washing machine, but I was going to wait 6 months, but I better buy it now because the price is going to be a lot higher in 6 months. Or a car, suit of clothes, a dress, furniture, whatever it is, better buy it now because the price is going to go up. That demand side inflation is called demand pull. You're basically pulling demand forward because of in anticipation of much higher prices. And there's a huge difference between the two. First of all, one can feed into the other. This is what happened in the 70s. The inflation in the 70s started from the supply side in 1974 with the Arab oil embargo as a result of the Arab-Israeli war, et cetera. It then fed in to prices, but then there were monetary blunders where the Fed printed too much money under Arthur Burns and G. William Miller, two of the worst Fed chairs in history. And then that changed the psychology. And then it came from the demand side. And that's when, gold went from $35 an ounce to $800 an ounce, 2,100% increase. And, but it affected everything. I mean, I was starting my career at that time and, I worked at Citibank and they, as International Tax Council, they used to just give us raises. We didn't even have to ask. They would just say, hey, here's another $30,000 or whatever, because they were afraid people were going to quit their jobs, and they did. So they would just give you a raise without even asking. That's how crazy it was. Now, so where are we today? Well, we're definitely getting the inflation from the supply side, and that's clear. But so far, it has not tipped into demand pull inflation. Consumer psychology has not changed. We're paying higher prices, but a lot of this is because demand is inelastic, meaning you got to pay the higher price no matter what. If you have to fill up your Ford F-150 pickup truck because you got to get to work or do your job or take the kids to school, whatever, and it used to be $75 and now it's $150 twice a week, you still have to do it. It kind of doesn't matter because you need the gas and you need the truck. Now, where it does impact the economy is if you do that, it's $75 that you don't have for something else. In other words, you're like, okay, I just paid a lot more to fill up my truck with gas or my SUV or whatever, but now I'm going to, not go out to dinner, not go to a concert, not go to a sporting event, not buy a new suit of clothes, et cetera, because I can't afford it because I put all my money in the gas tank. So we just talked about inflation, deflation, disinflation, global recession, some economies worse than others, supply chain breakdowns, so many, the war in Ukraine, so many variables. That you can give different scenarios. You can, say inflationary and deflationary scenarios. So how do you survive that? What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that diversification is good and all that. But the problem is they don't understand what diversification is. And I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly